Welcome to the O'Brien Brief. I'm Tony O'Brien. If you've been paying attention to credit markets over the last decade, you've watched something quite but enormously happen. Banks have retreated from middle market lending. Regulatory complexity has turned from used to be a 1 week loan decision into a 6 month process. Private credit has moved from niche corner of the capital stack to a $1.5 trillion industry, reshaping how American companies are actually financed. Guest today is one of the operators who's been inside that ship since the beginning. Michael McAdams runs Pasadena Private Financial Group, boutique multifamily office that provides national corporate lending to lower middle market companies with EBITDAs of 2 to 20 million. They've announced a national expansion targeting 40 states in 18 months. Michael spent his entire career managing a $1.5 billion retail credit fund and institutional portfolios up to $8 billion in syndicated loans. He has seen this market through every cycle since well before 2008. Today, we're going to talk about why private credit is winning, what it actually takes to scale a regional lender into a national operation, and what the next decade looks like for middle market companies that are going to need capital. Michael, welcome to the show.
Thank you, Anthony.
So we'll dig right in. But before we do, let's give the audience the short version of your background. You've operated inside credit markets at multiple scales. Talk about that arc from the institutional side to running Pasadena Private today.
Well, again, thank you. Thank you, Anthony. I've got 35 plus years of credit in banking, literally from a bank teller to the CEO of an $8 billion credit fund. I started with Bank of America, and every institution I worked with got smaller because I'm an entrepreneur at heart as well. One of the larger institutions I worked for became part of the JP Morgan Chase business. I worked for a couple different foreign banks, both in middle market credit as well as large corporate credit, and transitioned into money management in the early 90s. I started the first mutual fund to invest in bank loans. I did one of the first CLOs, one of the first Euro multi-currency CLOs. I ran a $1 billion hedge fund in credit markets, did 4 closed-end funds listed on the exchanges, a open-end fund invested in bank loans. I was the first buy-side chairman of the Loan Syndication and Trading Association. That's the industry trade association for really syndicated bank debt. I tried to retire. I had 6 or 7 clients around the world, from Los Angeles to Copenhagen, Denmark, and one guy who actually runs Pasadena Private Financial Group. I run the lending business, Pasadena Private Lending, asked me to help him start the lending business, and that took off, and that's where I wound up in my third or fourth career here at Pasadena Private Lending.
Wow, that's a lot to grab onto, and it's very, very impressive. So Pasadena Private is a multi-family office, but the lending arm is what we're going to focus on today. For a listener who doesn't know the difference between bank lending, BDCs, hard money, and what you do, where exactly does Pasadena Private sit, and why does that niche exist?
Well, you're right. We are something unusual. We have a special niche that I don't believe anybody else really does have, or at least they don't focus on the way we do. Banks lend when they have to in order to get deposits and fees, and that's really their business nowadays. Another player in our space indirectly, of course, is the Small Business Administration. They are inexpensive, but they're bureaucratic and slow. The hedge funds and BDCs, they do provide similar kinds of credit, but at a higher cost. But part of the issue is you have to find the right shop that does what you want them to do. They all have their specialties, and not necessarily works for everybody. And they're not exactly in the phone book, as they say. So you have to be able to find them. The true hard money lenders, or their evil twin nowadays, the merchant cash advance shops, they have to charge so much because they know they're going to have substantial defaults and losses. That's in a whole different world. And we try to actually maintain relationships. We go out of our way to to think of the entirety of the relationship with the individual as well as their businesses, and they may have several businesses. In most cases, we lend to successful entrepreneurs. This may be their second or third rodeo. This may be where they've retired once or twice, and they've got a new business that someone brought them that they're excited about, and it is pre the time period where a traditional bank might be interested or able to finance them. And yet, because they're wealthy, they don't want to pay 15, 17, 18%. So we're in that zone between what is a traditional bank financeable credit as between that and where a super high yield or a high yield financing might be appropriate. Again, because they are wealthy individuals with connections, with relationships, they're not comfortable paying high yield, and yet they don't qualify yet for a traditional bank loan. That's really our niche. And our chairman that came up with this idea when he was working for Merrill Lynch, originally I think it was partially to defend his relationships with clients that were investment clients that might have needed to go to a bank or other institution to get debt. Why not offer that service to their existing investment clients to keep them all within the family? And we've turned it around backwards the other way and said, look, let's make sure we offer this service, and then if we can help them in other ways with helping them buy or sell companies, providing 401k or other investment services should they want to, that brings them all into the multifamily office sphere of influence. So that's what we do. It's a lot different than just either what a bank or these other institutions might be able to offer.
Well, banks peaked their syndicated loan markets at 1.4 to 1.5 trillion and have been pulling back ever since. Private credit has filled that void. From your seat, operating in the middle market, what are banks actually seeing that's making them retreat? Is this a regulatory story, a return on equity story, or something deeper?
I think this is actually one of the shorter answers that I might give today to any question you might have. I think it's fear of risk. It's they want to manage their risks as the regulators see it. Back in the old days, they had high yielding credit risks that were layered on top of all other credit risks, leveraged buyout exposure risks. But I think nowadays it's anything that looks like a riskier credit, the regulators take a hard look at. But the second thing is that stock analysts are not looking for banks to have any kind of volatility in their earnings caused by credit risk, because any kind of volatility in earnings as a result of credit risk is discounted. They don't get the multiples, they don't get the stock price that they would have liked to, so they try to manage that away. You can do that by size, you can do that by diversity, but you can also do it by just not making as many loans or making much smaller commitments. And the view, driven in part by the rating agencies, is that smaller credits are the kind that when the economy catches a cold, the smaller companies catch pneumonia. That may or may not be correct, again, depending upon your underwriting standards. And since we tend to stick with the companies that are owned by wealthy individuals who have proven themselves, we don't experience that same sort of experience. We don't have that view that just because they're small, they're riskier. But in general, the banks just aren't in the business of making credit decisions if they can avoid it. If they can get large deposits and large fees to justify the exposures that they take, then they'll do it. But otherwise, that isn't in the cards today. And at least until a lot of change happens in the regulatory environment or banks find better ways to hedge out that exposure, it isn't going to change. And I think the days of banks being the largest lender to American business are gone.
There's been a lot of headline noise recently, right? Blue Owl, BlackRock, about overextension and private credit, like you've mentioned. You've been pretty direct that these are venture and tech finance issues, not systematic problems. Let's walk the audience a little bit deeper and how you separate signal from noise on private credit risk.
Well, I think there's maybe three things. The first thing that before I start the answer is there's a lot of smart people in private credit. To some extent, there's a lot of people that got tired of slow walking credits and saying no to good borrowers that got tired of working at big banks. And they said, that's not what I do. And they left, and the money people who were looking to find ways of putting money to work hired them. And now we have thousands of, or at least hundreds of great private credit firms. But yes, at least from what we're hearing and what we can tell from the outside and from some insiders that are willing to talk, is that the venture lending business does seem to be the center of some of the problems that have started to finally hit the private credit world. That is a different world. That's not acquisition finance. That's not working capital finance. It's not asset-based lending. It's a world that is based upon technological change, and certainly with any kind of technological change, not the least of which is the dawn of AI and the way it's affecting lots of companies, let alone those that are at the cutting edge of development. That's going to result in some companies not making it, and therefore there's going to be some losses. Now, if you're a large private credit firm and you have 1 or 2 or 3 or 4% of your business in that, it's not going to change your overall firm. Some investors that might have chosen to be specifically focused on that, they're going to take some losses. There's no question. But you as a firm are going to survive. I think secondly is every firm, every credit firm of every kind, whether it be credit cards or mortgages or large corporate, small corporate, is going to take losses. That includes JP Morgan, Jamie Dimon, his cockroaches, you name it, Pasadena Private Lending. We will all take credit losses at some point in time, even though, knock on wood, Pasadena Private has not in its 8 years of existence. It will happen. But after 15 years of perfect growth, the private credit industry has enjoyed years of the press referring to it as, the golden age of private credit. But you know what? Editors in the media get tired of writing the same article, or at least approving the same articles. And at some point in time, they start looking for what else they can talk about. And I think we're getting to the point where they're looking for other stories. And the slightest news of anything difficult or a story about losses or something going wrong in any firm gets a lot more attention than another story saying how great things are. And I do think that the media has taken those nuggets of cracks in the walls as an indication that here's a story that can be written. Let's talk about it, because that's a lot more interesting than another story about how great things are. Of course, we are also in uncertain economic times, and what's going on in the world today will have impact, and therefore it is appropriate to talk about the fact that everybody is more exposed to economic risk and therefore some credit risks just because of what's going on in interest rates and inflation. So it is appropriate to be talking about those risks as having increased. But is it that much greater than it was 6 months ago? It's noticeably greater, but not life and death different. So we shouldn't get too carried away. And then the third aspect of what's going on in the media is also appropriate for the media to have picked up on, and that is that some of the credit shops have utilized the interval fund structure as a means of financing their growth into certain strategies. Interval fund structure is basically a concept where every 90 days they offer to redeem X percent of their shareholders after a period of time. Let's say 5% after a 1-year investment is a typical structure. That's all fine, and it works on average over time. But as we all know, on average over time doesn't consider the fact that sometimes things don't work out on average. And so when you have a situation where the media starts to talk about possible risks, you talk about just pure random reality that some people want more of their money back this quarter than they've ever needed it before, and you breach the 5% mark, and everybody gets and more than 5% ask for their money back, and instead everybody gets 80% of what they asked for, it starts to freak people out, and they start to worry, and then the media hears about it, and it inflames it, and it becomes a good old-fashioned run on the bank, just like in It's a Wonderful Life, Bailey Building and Loan, to go back to that old movie. So the point is it's probably a violation of the old rule of don't finance long-term assets with short-term liabilities, and I think probably that will get cured. That'll stop happening simply because they tried it. It worked for a very, very long period of time, and now we realize it probably wasn't the right structure for long-term assets. But I don't think it's a widespread thing, but it has picked up. It been picked up in the press, and I think it's not as widespread as people might think, and it's certainly not endemic to the overall industry. It's certainly not something that we at Pasadena Private Lending have utilized for any of our funding at all.
You made the point that private lenders have more skin in the game than banks because of the personal economic risk. Someone running a $10 million EBITDA company evaluating a private credit lender versus a bank, what does that skin in the game actually mean for them in practice?
I should be candid in saying, many major banks require their senior management to have a substantial portion of their comp plan include stock in their bank. But with that said, most major private lenders are entrepreneurs. They're not bank administrative bureaucratic humans. They are people who want to grow a business. They want to participate in its growth and participate handsomely for all the time and effort they spend, 14-hour days and weekends sometimes on a regular basis. So they are willing to put in the time and the effort, but they expect to get paid. On the other hand, they also understand that if they screw up, it's going to come out of their pay. In the case of Pasadena Private Lending, every dollar of losses we take is the first dollar that comes off of our pay when the business is eventually sold, should it be sold. We know that is a dollar for dollar cost to us in the senior management if we lose a dollar. That's something that's on our head every time we make a loan and every time we have any concern about a credit. I'm sure good lenders, no matter where they are, think about that, but I think it's a little bit different when you are an entrepreneur by heart and you know that's going to come out of your pocket first.
Banks are now lending to private credit funds rather than directly to borrowers. That's a fundamental restructuring of the credit stack. What does that mean for the next decade? Does private credit eat the entire middle market, or does the bank to fund borrower structure become the permanent shape of how things work?
Look, the local banks and small regionals will always be there. We talk to many lenders as part of our credit line, and they all say to us every loan we make, they would like to be able to make, typically as an exception because we don't necessarily need to follow FDIC regulatory policies. But they say they're sound, it's just that they can't make an entire portfolio of exceptions. They're allowed to make occasional exceptions in the loans they make that says that they're proper loans, but they're given some authority to make some exceptions on occasion. We're in the business as a non-bank of making good loans based upon our judgment, based upon the facts we have, and based upon knowing the borrower and the circumstances, even if they don't meet the letter of the bank regulatory requirements, because we've been there, we have a lot of experience. So some of those institutions will always find the ability to do the occasional exception, so they'll always be there for some of their borrowers. However, I think more and more the medium to larger size banks just can't afford the scalability to be involved in the small to middle sized businesses, and they'll be doing it through funding people like us, funding other lenders. It gets them into that marketplace for the yields that we offer, that those borrowers offer. It allows them to do so efficiently because we can make, by making a loan to us, they may get 50, 60, 70, 80, 90 loans in exposure on a very diversified basis, subject to whatever requirements that they will impose upon us. We won't accept all of the bank regulatory restrictions, but we may accept some restrictions in buckets and baskets that are prudent, but not necessarily check the box FDIC type requirements. And thirdly, it gets them, as I said, it gets them the yield, it gets them the exposure. And lastly, by doing it through us, they get the additional capital support that we have in making those loans, so that they're getting that loan with a little more capital beneath it. So it's a way of staying in the middle market. And I guess if you take it, the next step is, as that borrower gets bigger, then maybe they can pluck the fruit that has matured as those companies get bigger. It gives them the opportunity to keep their eyes on some of those companies that are getting a lot bigger, that are growing out of our size. Welcome to let those borrowers move on to the bigger institutions as they get bigger and better. But I just don't see them coming back into this marketplace. I think the days of banks being in this marketplace are gone.
Let's shift gears for a minute and talk about how you evaluate a deal. Your borrowers are mostly established entrepreneurs with EBITDAs between 2 and 20 million. And you've been clear that experience and net worth matter more than credit score. Walk us through what that underwriting conversation looks like, what you ask, what you verify, and how you get a deal done in 2 to 4 weeks when a bank could take 6 months.
We just ask ChatGPT and it tells us what to do. No, we do. I'll walk you through the steps, but look, we have a fair amount of stuff that is downloaded and dropped into our standard analytics models. So we do use a fair amount of technology to speed this up. So that does help us move a little quicker. But our process is actually somewhat old fashioned, and in that regard, I think is quite appropriate. That is, we start off with, we only finance businesses that are owned by individuals, 1, 2, 3, 4 people, typically 1 or 2. That is not by private equity firms. We believe that that is an untapped marketplace, or that's the marketplace that we have chosen, owner-controlled businesses. So it has to start with that. Secondly, it has to be a company that fits our box, which is typically not a high commodity risk business. We don't finance real estate acquisition, construction. We are a business lender. We don't finance startups. We don't finance crypto or cannabis and some other forbidden industries. And then we do background checks on the owners and the business to see what their litigation and their lien search, and whether they've had any issues with the law. We want to look at character. We want to see what they've been doing in their life, and those things matter a lot. They tell us a lot about the character of the borrowers. With that behind us, we have either an in-person meeting or a Zoom meeting if it's more convenient initially. It might be a half hour, it might be 2.5 hours of understanding the business and who they are and what they're trying to achieve. And in that meeting, we'll have a very frank discussion that says the way we underwrite is we require a personal guarantee from the owner. It's an important piece that allows us to take some shortcuts in the rest of our underwriting, knowing that we have an individual who's personally guaranteeing the loan with a substantial outside net worth. It makes us feel more comfortable about things like fraud risk and their dedication to the business. That doesn't say we don't check for that. We get tax returns and we compare it to bank accounts, and we care very much about the kind of financial statements we're being given as to whether or not they're credible or not. But having that personal guarantee is very, very important. We'll get an NDA and we will go through the financial statements and the personal financial statement, and we'll spend probably the majority of our initial time looking at the financials the way anyone would do. We build our own projection model, again, assisted by some degree of downloading of their financials into a standardized model that we've created. Second call with management to make sure we've understood things, and an internal credit meeting, which we can call with 20 minutes of notice, because there's really only 3 primary decision makers, and there might be others if it's a specialized credit in some way. We have some people that we rely upon if there's specifics to an industry or a company that we need to know about. Assuming it passes through all those gates, we will issue an indication of interest, which is a non-binding way of saying, this is what we're thinking. This is the terms that we'd like to offer you. Does this work? Did we understand what you said you needed, and did we get that right? And if it takes 1 or 2 more drafts to get that just right, we'll ask them to sign it, and we'll do a complete lien check and a further background check. And with that being signed, we'll go to a final term sheet that is binding upon us. It'll ask for some additional information of everything, all their corporate documents. Basically, that puts us into legal documentation. We will make sure that the structure that we have drafted actually works as we work with our lawyers. Sometimes it means we have to go back to the borrower and say, the entity that you suggested doesn't work. There's issues with that entity, or the documentation doesn't allow us to make that entity the borrower. We need a co-borrower, or we need another entity. But that might be 3 days, it might be 2 weeks, depends on how easy it is for us to use the entity and the structure that we both had preliminarily agreed to. But again, depending how easy that structuring part works through, we can close 2-3 weeks, and it tends to work quite well. Again, depending, usually not on us, but because we are often the first institutional lender to many of our borrowers. Many times they've had real estate mortgages, they've had factoring lines, but not really a traditional corporate line like we provide. So they may not have all their organizational documents together. They may have not provided they may not have corporate organizational documents even drafted or completed or board minutes. All those things need to be done before we're comfortable. So sometimes takes them some time to get that stuff pulled together, but we work with them and we get it done as quickly as they can get it done, and then we close. That process is not that hard because we're very borrower friendly. We can do that in weeks as opposed to months at a big bank where it goes from one desk to another desk and it sits there for 3 days and then goes to another desk for 4 days and goes to somebody else over the weekend and they don't have a backup and they go on vacation. It sits there for a week. That's not how we work. So
Yeah.
we're very, very focused on meeting the client's needs.
I found it interesting that you built a credit committee directly to the customer facing process, where you and your partners join the call with prospects from the first conversation. Most lenders run the credit committee as a back office function that slows everything down.
Yeah.
Why did you build it this way, and what does it deliver for borrowers that they can't get from a traditional process?
Well, we're entrepreneurs too. We understand what entrepreneurs need and try to do. We're trying to build relationships. We often have all three members of the credit committee on, if not the first, certainly on the second uh, borrower call or meeting. We always meet with the borrower in person at their plant or their building before the deal closes. It's all part of the personal touch that we try to do. If we have bad news, we get on the phone and tell them, or a Zoom. If we say, look, we've discovered an issue, it's just all part of the very personal touch. And the fact that we literally get three people on a call with them, they're like, you mean there's nobody from Chicago or Tokyo or London? Even if it's bad news, they're blown away that we take that much time and focus to be that communicative. And we find sometimes that getting on the call with them, they go, well, I guess I should have explained it this way. And then suddenly the committee's happy because we've heard the whole story. We're directed to their CPA or to somebody in their production department that says, oh no, we told it to you wrong. This is how it really is, and here's the document that proves it. So it just moves things a lot quicker.
Let's talk about expansion. You're planning on expanding to 40 states in 18 months. The infrastructure to support that is already in place. The technology stack with AIO Logic business development hires the inbound digital flow. That's now running at a deal a day. That's impressive. What's the harder part still ahead? And what does becoming $1 billion firm actually require operationally?
Well, let me back up and say, look, we've been doing this for 8 years with half the business already on the West Coast and half in probably 12 or 14 other states. So this isn't a complete remake. It's just an extension of what we have learned to do. We're just basically saying, look, if it works in the sixth largest economy in the world, which is California, throw in Arizona, Nevada, 1 or 2 loans in Hawaii, we can certainly, and it's worked in 12 or 14 other states. There's no reason why we can't push this out further. The real issue is extending our existing national relationships, and we already have some. We get about 25% of our loans from existing borrowers, from Young Presidents Organization, Tiger 20, just existing relationships where a borrower is on the third tee at their favorite golf course, and he tells his buddy, you're looking for a loan. These guys treated us really well. So, those kinds of relationships already exist. So it's extending those relationships nationally and then selectively picking 2 or 3 regions where we're going to focus first. We're still figuring out exactly which ones they're going to be. We're not going to take on 40 states. We're going to take on probably 5 or 6 with 2 or 3 major cities as the hubs, and building the same kinds of relationships we built with accountants, lawyers, registered investment advisors, and small and regional banks, where we can assist them in winning deals they couldn't win on their own, taking deals off their hands that they can't do because it doesn't fit their box, helping them win deals that are too big for them. And it'll take time to build those relationships. We figure it'll take a year or two to make those contacts and convince them by showing them we can and by turning around offers of credits where we perform. It may be that we have to turn down the first three they show them, but we'll do it quickly and we'll do it intelligently so they understand that we're real and that we are as responsive as possible. That's all people can ask for at first. I've done this enough times in enough iterations in my life where oftentimes the first deal you get when you're the new kid on the block is an absolute wacky deal, and they're just testing you. And if you do the first one, you'll never see another one anyway. So you have to sometimes turn down the first deal people show you just to show that you are a thinking, intelligent, and credible lender. But that's the only way you build the credibility within an institution, is to say you don't do everything, you just do the good stuff. And that's what we will have to do and earn our way into those relationships over time. The other thing that we have to do is even though we have approaching $500 million of capital today, is we will have to raise some additional capital as we get above $600 million of capital. We'll have to raise some additional capital, and we've got our oars in the water already for that, both from direct sources as well as potentially through securitization, some other projects that we're working on. But that's something we have to kind of do all the time. When you're in the lending business without raising additional capital, both junior capital and senior capital, you don't grow. I mean, that's our inventory on the shelf. So we're always in the business of raising capital. So that's not hard. It's just additional work we have to do through our friends at AIO Logic and other systems that we are utilizing. We have gotten pretty efficient at taking care of our growth and taking care of existing clients and monitoring our existing portfolio. So I'm not tremendously worried that we can't double our portfolio without a whole lot of additional work.
What's the biggest misconception about private credit that you most want to correct on this podcast today? When you talk to family offices, institutional allocators, potential borrowers, what's the wrong story they're carrying that you'd want them to update?
I would say private credit is, as we said at the beginning, it's the future. Walking into a building with marble columns and walnut walls and thick carpeting, those days are gone. It's not the way it works any longer. 7 levels of vice presidents and all those trappings of traditional financing sources. It's just not the way it works. And I think that banks, if they're going to compete, have to figure out how to be more nimble, have to find ways to make loans into the boxes that non-banks have figured out and keep the regulators happy. And until they do, which won't be days, weeks, months, it will be a decade. The only people that can do that are those that are willing to put their careers and their compensation at risk every day by being a non-bank institution without the guarantees of the FDIC, and saying, I know what I'm doing, I have experience, and I trust you, and I know I can get my money back somehow so that my investors don't fire me. That's what we do. And that's what we have to be able to do. And I think borrowers have to understand that because we don't have that cheap source of funds, it's going to cost you a little bit more, but you'll get treated like a customer. You'll get quicker turnaround, and you'll get assured service that large banks start to look like the post office if you're not careful. That's what they learned. That's what they became over the last 20 years, at least if you're a lender. If you want to open a deposit, boy, they'll jump right on it.
Yeah. All right, last question on substance.
Yes.
If a listener is running a middle market company today and starts to think about whether private credit is the right capital source for them, what's the one question they should be asking themselves first?
Okay, I'll amend your question by saying there's 2 questions. The first thing is they have to say, is debt right for me? Sometimes we have people that say, I need a loan. And then when you start asking them, are they prepared to live with covenants? Are they prepared to pledge collateral? Do they even have collateral to pledge? Are they prepared to provide a personal guarantee? And how volatile is your business to be able to live through making payments even through the difficult times? Sometimes maybe I should be looking for equity. Assuming they answer yes, my business is ready for debt because I don't want to dilute my ownership, then the next question is, how much time do I have to raise this debt? How much patience do I have? Have I walked into my bank and they said it'll take me 5 months to figure this out? Have I been in business for 3 or 4 years without any hiccups? Because the banks will say no. Do I care about the rate? Do I just want the money now at any cost because I have to do it with immediacy? We've actually had borrowers that say, I need it in 5 days. Can you do that? I'm sorry, we're fast. We're not that fast.
Right.
And that's where a hedge fund or a BDC can sometimes, not necessarily a BDC, but a hedge fund can possibly do it, but they're going to charge you through the nose. But if it's a reasonable business request in a period of 2 to 3 weeks, a private credit offer can usually take great care of you and be very responsive and a reasonable price. And I think that's really what it comes down to. If you, and by the way, most private credit shops, they don't care where you bank. You can still keep your existing banking relationship and your existing credit cards and go to the same teller on Friday afternoon if that's what you want to do. They don't care. But the reality is that when it comes to where you're going to get the credit and how you're going to administer it, that's what you really care about if you're borrowing. And I think there are a lot of people that can help you, but if you're in the lower end of the middle market and you're an owner of a business and you've got a story to tell, a credit story to tell, I think that's where someone like Pasadena Private Lending, I think that's where we excel at taking great care of people.
All right. One personal question I'm going to ask you before we let this thing go. You've been operating for 25 years. What's the one lesson from your career that informs how you run Pasadena Private today that you wish you had known 20 years ago?
What I probably have seen is people who think that just because they do good in one area or make a lot of money or make a lot of great decisions in one area, they somehow think that they're a genius in everything. Just because you're smart at one thing doesn't mean you're smart at everything you touch. Stick to your niche, exploit it, expand it, defend it, but just because you're good at one thing doesn't mean you should do everything. If you're good at senior lending, you shouldn't go into subordinated or equity. If you have a platform that brings you that kind of business, bring in somebody else to do those things. Use your business as the distribution or as the people that bring in the business, but don't think that you necessarily are as good at that. Just because you're good at this doesn't mean you're good at that. I've seen people that were great at X, they decided to go into Y and they didn't excel. I think, you're a tailback. You're not a receiver. Okay.
Right. Michael, this has been a fabulous conversation. For listeners who want to learn more about Pasadena Private Financial Group, we'll link to the firm in the show notes. Michael McAdams, thank you for your time today. We really appreciate it. The lesson was valuable. To our audience, you got value out of this conversation, share with someone who's thinking about a capital strategy for their businesses. We'll be back next week with another guest building serious things. Until then, I'm Tony O'Brien. Thanks for listening to the O'Brien Brief.